Good morning, afternoon, or evening, everyone. Thank you all so much for joining us on another episode of Coffee and Cryptos. I'm Ryan, and today I'm drinking my favorite drink, a caramel macchiato. As always, if you're curious on how to make your own caramel macchiato, be sure to check out Dominique's video titled Starbucks Caramel Macchiato at Home. So for today's video, I'm going to share the secret on how to become a millionaire. The trick is easier than it seems. Let's get started. Those of you who have been keeping up with the channel might already know where I'm going with this, and I have to apologize for the shameless clickbaity title, but the real way to become a millionaire is, wait for it, that's right, an IRA, or an individual retirement arrangement. I know, some of you guys are probably disappointed to hear that, but before you say I'm lying, what I've said is technically true. An IRA will make you a millionaire. The only kicker is that, well, it kind of takes your whole working lifetime to do it. So I haven't been completely dishonest with you all, but exactly how does an IRA make you wealthy over the course of your life? Let's take a look at the calculator first. Say you start at age 18 with $0 and you start putting $500 a month into your Roth IRA, which is the current maximum monthly amount that you can put in for a single individual. Assuming you reinvest your dividends, achieve an average return of 8% a year, have a marginal tax rate of 22%, and an inflation rate of 3%, you'd end up with $2,717,401 at age 65. This is totally achievable in terms of the history of the stock market because historically the stock market equates to growth of about 8% a year. This doesn't mean you'll get 8% every single year, but rather that some years are higher than 8% and some are lower. However, it can be difficult these days to find $500 to put away each month, and inflation is much higher than 3% right now. All these factors affect the long-term performance of your Roth IRA, but even starting with what you can comfortably contribute is a better start than most. Put simply, an IRA is an investment vehicle, which is a place where you can park your money, buy your choice of funds, and simply let time and compound interest do its thing. Now, a Roth IRA is taxed up front based on your current tax bracket, so it grows tax-free, and you don't pay taxes on it when you pull it out at retirement. A traditional Roth IRA is taxed when you pull it out at retirement, at the tax bracket you'll be at that age. Now, regardless of which one you choose, the principle is the same. You open an IRA account and you choose from a variety of individual stocks, mutual funds, index funds, and/or exchange-traded funds. These will be what allows your principal investment to gain value over time. Now, different financial institutions offer their own exclusive funds, but they take a small cut for you using them. This is known as the net expense ratio, and it tells you how much they'll take for every $10,000 you invest into that fund. For example, let's take a look at VFIAX. Now, this is an index fund that is offered by Vanguard. It says that it needs a minimum of $3,000 for you to invest in it, and that it has an expense ratio of 0.04%, meaning that they'll take $400 for every $10,000 you put into it. However, there are better options where you don't need to deal with high account minimums. Many financial firms now offer funds that can be started with just $1. But what are these types of funds? Index funds are designed to track an index like the S&P 500, the Dow Jones Industrial Average, or the NASDAQ Composite, and consist of holding the same securities in the same proportions as those indexes. They hold similar amounts of particular stocks and bonds in order to bring you a similar return on your investment. The S&P 500 is a bucket of 500 large-cap U.S. companies that make up 80% of U.S. equities by market cap. The Dow Jones Industrial Average tracks 30 large publicly owned blue-chip companies such as Walmart, Home Depot, McDonald's, and Coca-Cola. The NASDAQ Composite tracks more than 3,700 stocks that include some of the largest technology giants such as Google's parent company Alphabet, Microsoft, Amazon, and Tesla. Now, mutual funds are used interchangeably to describe index funds because technically an index fund is a mutual fund, and sometimes a mutual fund is an index fund. Now, investors can buy an index fund that's either an exchange-traded fund or a mutual fund. They can also buy a mutual fund that's a passively managed index fund or an actively managed one. It all depends on your style of trading and your risk tolerance. Exchange traded funds, or ETFs, are basically the stock version of buying index funds. Unlike mutual funds, they trade throughout the day, just like a share of stock on the market. Index funds are typically viewed as a passive form of investing compared to a mutual fund that invests in an actively managed fund. These funds have the goal in mind to quote-unquote beat the market and try to return more money to their clients. Now, index funds simply match the market, but that's not bad considering what it can do for you in the long run. Now we get to the juicy part, which are my favorite index funds and ETFs personally. I must disclose that while I do personally use Charles Schwab, I was not paid by them to endorse their services. Starting off, we have SWTSX, which is an index fund that tracks the entire stock market. There is no minimum initial investment, and it has an expense ratio of 0.03%. Next, we have SWPPX, which is an index fund that tracks the S&P 500. There is also no minimum initial investment with this one, and it has an expense ratio of 0.02%. Then there's SCHX, which is an ETF that tracks the US large cap Dow Jones Industrial Average. No minimum initial investment, and has an expense ratio of 0.03%. Also on the list is SNXFX, man, that's a tongue twister, which is an index fund that tracks the top 1,000 large cap companies. Like the others, no minimum initial investment required, and still a low expense ratio of 0.05%. Other honorable mentions include SWLGX, SCHK, SCHB, SCHD, SCHG, and Invesco QQQ, all tongue twisters. Now, IRAs are pretty much a necessity to ensure a comfortable retirement, in my opinion, but I wouldn't be in crypto if I didn't believe that cryptocurrency could get me to retirement faster than an IRA. For me, that's always been one of the main selling points of crypto, aside from the innovation in the space. The fact that it can potentially bring you wealth without waiting your whole life to do it is why I think all of us should hold some amount of cryptocurrency. Well, that's all for this one, guys. I hope you learned something new today. As always, thanks for watching, and don't forget to like and subscribe if you enjoyed the content. Follow us on Instagram at Coffee and Cryptos, and I'll catch you on the next one. See you around.